So we're going to talk about the last data set, which is super helpful for finance and accounting majors. This is about the compensation. So again, the flow is the same. We talk about the structure of the compensation contract, the structure of the data, and then how we use the data. What's to use the data for? So the general idea is we can use the data to make managers to work harder, to resolve agency problem. You know, the agency problem is there's a separation between control and ownership. The people who control a firm are not the people who own the firm. So there's agency problem. Like you are giving, you are kind of outsourcing your project to some other people to do it. Then why your friends should work hard for you, right? So this is a typical agency problem. So what compensation normally can do is, by analyzing the compensation contracting data, you can identify the efficiency of a compensation contract. And also you can see how you can make a CEO work harder. You can make them to predict the future performance. So basically it's about motivate and control manager teams. It's about how after you motivate the manager team, after you control for the manager team, after you resolve agency problem, you will deliver better firm performance. That's basically the idea of data analytics for executive compensation. So let's see the structure here. So normally compensation means there's a basic base salary, incentive plan, and other pension, and the medical care, blah blah blah. And the incentive plan has the short term and the long term. So what does that mean? Means the base salary. In a lot of cases, some CEO, they only want $1. So they say they want to signal that they don't want too much money. They just want $1 base salary. And then what do they want? If they're doing well, they can get paid more. If they don't doing well, they don't want the money. So there's a $1 CEO. There's a lot of $1 CEO in the recent years. They only need a $1 base salary. And most of the income actually from the performance-based plan and the short-term, long-term. The medical care, that's one stuff. So this is the big structure of the compensation. That's how CEO get paid. How CEO. This is similar to you guys, right? When you get a job, this is very similar to your plan too. You will have a base salary, you will have a performance-based, you will have a medical care, blah blah. This is very similar to your future contract as well. So let's look at the details. Let's look at details. How exactly the compensation design? What do compensation design have? So this is the format of the compensation design. So what we have is sometimes you pay out cash, sometimes you pay out equity stock options. So this you have different format to pay out. And then there's a vesting condition. What does vesting condition means? The pay may be contingent on something, sometimes contingent on time. So why contingent? Why the pay is contingent on time? So let's say I hired Yihan, but I told Yihan, in order to get the money, you have to stay for 3 years, and then you can get the money. So this is a time contingent. You have to work for the company for enough time in order to get the pay. And then we have a performance contingent. Performance contingent means what? You have to hit certain performance in order to get the money. So for example, I can tell Yihan, you have to make the sales over $100 million, you can get the bonus. So this is like a rough structure of the compensation. You can see that first, the payment can be in cash, can be in equity, can be in option. So the payment has different format. And the conditional payments, conditional pay has different condition. You can condition on time. If you stay longer enough, you can get the pay. Or you condition on performance. If you have deliver different performance, then you can get the payment, you can get bonus. So this is the more concrete compensation structure. We'll go step by step. We'll make it more complicated. And so, yeah. So You guys, no problem. Hear me out, right? Okay. Okay. So let's say let's look at the compensation contract. So you see that for the award type, you can avoid cash, stock, options. So the format wise, you have different options. And for the contingent pay, you can either just give a fixed pay, or you can contingent on time, or you can contingent on performance. So that means the compensation design has a lot of options. So when you should use stock, when you use options, when you should be time contingent, when you should be performance contingent. So many options. So what you should do? Here comes, you need to analyze the data, compensation data, to figure out what would be the optimal contract for managers. What would be the optimal contract to motivate managers to work harder and deliver better firm performance? So these are the options in the contract. So regarding the performance pay, so among the performance pay, there's a different performance pay we need to pay attention to. So first of all is what kind of performance we rely on. Sometimes you can rely on the stock price. If the company hits $10 stock price, then the CEO get paid. If not, it doesn't get paid. So sometimes it's based on the fundamental. If the earnings hits $5, get paid. If the sales hits $5, get paid. Or some intangible metrics, for example, customer satisfaction or employee turnover. If the customer satisfaction gets to be high, the CEO get paid. If it's low, you will be unpaid. If the employee turnover is low, the CEO get paid. Otherwise, unpaid. So there's a lot of decisions to make. So which metrics you need to rely on? Should we condition on the stock price? Should we condition on earnings? Should we condition on the sales? So these are all the decisions the corporate rely on your data analytics to determine which are the best metrics to monitor the CEO, to make the CEO work harder for shareholders. So these are the different metrics. And another important idea is the absolute versus relative. What does that mean? Absolute means when we define the stock price, if my stock price compared to my past stock price, this is absolute. So let's take an example. Let's say Haixin. How do I evaluate Haixin? I compare Haixin's this year grade with Haixin's previous grade, last year grade. The change for Haixin, that's a absolute evaluation. Just compare Haixin, the current Haixin with previous Haixin. So what is relative? Relative means I compare Haixin with Yihan, with another, with Connie, with other students. That's relative benchmark. So we'll discuss why sometimes we use absolute benchmark, why sometimes we use relative benchmark. So these are the different ways to benchmark CEO. That's why I'm saying the CEO compensation is kind of complicated. We need to understand the structure first, and then we can do analytics on it. So here, among the peer group, there's a different ways to do that. So sometimes you can compare against the peers, or you can compare against the market index. So you have a different ways to do the absolute and relative. So here is the example. Here is the example of the compensation. You can see what type is cash, and the vesting here is short, and the matrix is accounting. They're based on what? Sales. So basically, if the sales or profit hits something, they can get paid. And it's absolute. Absolute means what? That means they compare the sales with previous sales. If it's relative, means what? Relative means they compare sales with other firms' sales. And this is the ground value. And this is option stock. And this is long horizon, and this is time. So if they stay enough time, they will get paid. So you can see that this is a very simplified contract. For the cash payment, the horizon is short. The conditional on the sales, and also it's absolute. It's not relative. And for the option and stock, it conditional on the time, not on the other stuff. So These are the contract. These are the contract you guys have to keep in mind. So these are a lot of options you have to make. For example, should we give a high fixed pay? Should we give a high time contingent? Should we give a high performance pay? So these are the options you need to make. Do you give cash options? This is also option you have to make. And which metrics you want is here. They choose sales or the profit. Why choose sales over earnings? Why choose sales over stock price? These are all decisions you need to make. And also relative, also absolute. The condition is absolute. Why use absolute? Why use relative? So and these are all doing the analytics of the compensation contract. These are all information you need to think. What's the objective? The objective is to make managers to work harder to maximize the profit for shareholders. So you want to design a contract that is maximize the CEO's effort to maximize the shareholders' value. That's the purpose. That's the purpose. Okay, and so let's see an example. Let's see an example of the absolute evaluation, performance evaluation. So it's this is LED. It's a pharmaceutical company. So in a pharmaceutical company, what we have here is, so you can see that if the stock price, is less than $42, no pay. If the stock price is in this range, they get 40% of the bonus. If the stock price in this range, 60% of bonus. If the stock price in this range, 80%. If the stock price is greater than $62 and the bonus, they get 140% bonus. So this is absolute pay. Absolute. Why is absolute? It's benchmark against absolute number. Benchmark against absolute number. So this is absolute evaluation. And you can see that when you work harder, you get more pay. If the performance is low, you get the lower pay. Okay. So one question I want to raise here is, what if the CEO, they get a high stock price just by luck? So for example, the Federal Reserve issued a lot of stimulus plan. The stimulus plan kind of boosts the stock market high. So what I'm saying is, if the stock price hits $62, it's not because of CEO effort. It's just because of luck, just because of the government is doing something. In that case, should we actually still give the manager $140 bonus? Should we do that? Should we do that? This is a question I want to raise here. Basically, the question I want to raise here is, if the stock price hits $60, is that because of manager effort, or is it because of some random fact, government fact, which has nothing to do with the manager effort? If that's the case, should we still award manager for 140% of bonus? Keep that in mind. We talk about that. Okay. Keep that in mind, that question. And the second question is, the second one is relative. So in the relative, what you see is, this is the peer group. So this is peer group. Baxter, I think it's a pharmaceutical company too. So this is a peer group. So what does this mean? Means if in a peer group, if you're below 25%, you get 0 bonus. If you are above 25%, you get 25% bonus. If you are 85% of the peer group, you get a 200% bonus. So this is the payout structure. This is a payout structure. Okay, payout structure. And so in other words, it depends on where you stand. So previously, what you see here is previously, you see here, the benchmark is against the absolute number, right? Against absolute number. And here, what you see here is, you are not given an absolute price. You have to see that if the firm is ranked, depends on rank among the peer group. If the rank is above 85%, you get 200% pay of the bonus, 200% of the bonus. So I want to bring up the question I asked. In that case, earlier I was saying, if the company is doing well, $62 is because of luck, not effort. What should we do? In this case, do you think the same thing will happen in this case? Do you think the company, the managers will be paid by luck instead of effort? So the answer is will not. The reason is because if it's luck, everybody will get luck. Everybody will get luck. So in that case, if you can beat someone, that must be your effort. So for example, for this class, if I give everybody 5% bonus, then your relative rank still stays the same. So because everybody get a 5% bonus, so in order to stand the 85% of rank, you have to make effort that is idiosyncratic to you. So in this case, the luck story will not stand. Luck story will not stand because everyone get luck. Everyone get the Federal Reserve support. Everyone get the luck. And if you can beat other people, that means it must be your effort, not your luck. So that's one important thing you can understand in a compensation design. So let's look at another compensation design. So this company. So this company. So this is a peer group. So this is the peer group, and you can see the performance. You can see the performance. It's same. If it's number 1, 200%. If it's 2, 175. So this is a very similar case. Very similar case. Depends on where you stand. Depends on where you stand. If you stand lower in the group, you get nothing. If you stand higher in the group, you get 200 pay over the bonus. So this is the peer group. This is the peer group. So so just to look at just to quickly go over the structure, you can see that this is a very rough structure of the compensation, very rough. And we go more details. You can see that cash, equity, time contingent, performance contingent, and then we go more details. We say that among the types, we have a cash, stock, options, and for the performance, we further break down. For performance, we have a market-based stock price. We have a fundamental-based earnings, and for the benchmark, we have absolute versus relative. And I raise you guys question: the absolute, maybe you are paying CEO by luck, right? You are paying lucky CEO for absolute performance evaluation. You are paying CEO who has luck, but for the relative, it doesn't have that issue because everyone has luck. If you can stand 85% of the group, that means you are making effort, not by luck. And another example is the same, right? You can see that if the lower group 0 payment, higher group 200% of payment. So we understand the structure of the data. Now comes back to the question. The question is, what should we use the data for? What should we use the data for? So we kind of discussed the first. We kind of discussed the first question: is the performance driven by luck or effort? We want to pay CEO who make effort. We don't want to pay CEO who just lucky CEO. So how do you resolve that issue? Yeah, you can use relative instead of absolute, right? That's what we discuss. And then another thing is the luck has 2 types of luck. It has a positive luck, has negative luck. So for example, if I so for example, if someone if the economic just go down, it's just COVID-19. COVID-19 is a big case. COVID-19 make everyone performance bad. Should we penalize managers who did bad in the COVID-19 period? Should we do so? If you do so, talent will leave, CEO will leave, right? Does it make sense? So what I'm trying to say here is, even for luck, you have to break down into positive luck and negative luck. If CEO has a positive luck, you shouldn't reward them, because this is luck, this is pure luck. But if the CEO has the negative luck, the COVID-19, we should not penalize CEO because they have negative luck, because this is out of his control or her control. We want to do so because we want to retain the talents. If you want to penalize someone, for something he cannot control for, nobody will stay, everybody will leave. So for example, during the COVID-19, if you penalize CEO performance because of the COVID-19, the CEO will leave. So this is something you guys think, what's the data should for? You can use the conversation data to answer those questions. How can you motivate, how can you make a CEO work harder to spend more effort? How can you just rule out those lucky CEOs? You don't have to pay CEOs by luck. So that's one question. Another question is, for the luck, you have to break down positive and negative. For positive luck, don't reward CEO for positive luck. Otherwise, we are all free riding. I will just wait for luck. But do not penalize CEO for negative luck. You cannot penalize someone for something he cannot control for. Otherwise, talent will leave. So these are the story and the stuff you guys can think of. This is quite interesting stuff. You can use the compensation data to do the analysis to help to motivate any manager to work harder. And another big question we have is overpayment. If you guys read the news, there's a sentiment going on. We are paying CEO too much. The shareholders are paying CEO too much. So how much is too much? So you have to define the too much. What is overpayment? Like, how much is too much? So then this becomes very comprehensive story. What's the benchmark? Do you compare the CEO payments with the PS payments, or you compare the payments with the absolute numbers? So these are all you have to do, use data analytics to come up how much is too much. So right, that's some data work you guys can figure out. We don't want to overpay CEO, but we don't want to underpay CEO. You have to define how much is too much by either relative or absolute. So this is another interesting question you can think about using the compensation data. Another question you can think about is, should we pay CEO by their input or output? So what does that mean? So for example, let's say Yihan works so hard in the class, but the just output is just not good. So should I compensate? Should I give good grade for Yihan just because of his effort, or should I just completely based on his output, like the performance of his exam? This is also debate we have in the corporate finance or corporate finance. It's even in the class, right? Some talk to me, how I, Professor Chow, I worked so hard, I just didn't do well in the exam. Can I get some credit? You know, this is the debate in the theory. Should we compensate people by their input or output? It's difficult to answer. It's difficult to answer. For us, we definitely output. I just want to make it clear. For us, we definitely based on output. But for the corporate world, what is input or output or mixed of both? That's interesting questions. You can do the data analytics to figure out what's the best way to motivate managers to work harder. That's the punchline. That's the punchline. And also another one you have to think about is, like, what metrics should we based on price? Should we based on earnings? Should we based on sales? These are also, when you're doing the data analytics, you can provide the information to the board of directors, to investors, and how to choose peer firm. So in the case, they choose this as a peer. Can they do some manipulation? I choose some easy ones. So for example, Yihan, I don't choose Yihan as my peer. Yihan is too difficult to beat. I'm going to choose someone else to easy target. So yeah, that's also interesting questions. You can see how they choose peer firms to benchmark with, benchmark against. These are also interesting questions to investigate. And the say to pay. What does say on pay? What does that mean? That means investors can say something about the payment. Investors can say CEO is paying too much. Investors can say that the duration, that the compensation is not good, that the contract is bad. the investors can voice out their opinions about the CEO compensation. So this is something you guys can also analyze the contract. You can help investors. You can help invest. A lot of hedge funds, they actually do say unpaid. Hedge funds, when they're unhappy about the compensation, they will file proxy fight to the company and saying, well, you guys are paying too much. I'm not happy with that. Or sometimes hedge fund can say, you guys are paying too low. This one CEO has no incentive to work. So a lot of investors, they can say something about the pay, file proxy statement to make sure the compensation is efficient. But how do you know compensation is efficient? That's the hedge funds need your guys to do the analytics to figure out what's the efficient way to form the contract, and that they can voice out their opinion to make the contract correct. So this is say and pay. Another stuff I want to talk about is in 2006, SEC in 2006, SEC require firms to disclose detailed compensation contract after 2006. So in other words, before the 2006, firms do not have to disclose the details of the contract. They can just give a summary. But after 2006, firms has to disclose detailed information about a contract. So everything I'm talking about here, all the details I'm talking about here are required to disclose after 2006. Before 2006, the firm, if you want to disclose, they disclose. If they don't want to disclose, they just give a summary. And after 2006, firms are required to disclose the details of compensation contract in the proxy statement, which is a Form 14A. So this is the compensation data. Let me have 2 minutes to just wrap it up. Let's have 2 minutes to wrap up. So what I want to say here is you need to know the structure of the compensation. You need to know the institutional background of compensation. You need to know that. And once you know that, you need to use the data to answer some questions. For example, can you design the compensation contract which pays CEO by effort, not by luck? Can you differentiate positive luck and negative luck? Can you do not overpay CEOs? Can you find out which one is optimal, pay for input or pay for output? Can you find out which metrics, stock price, cash, and sales, which one is better? Can you help firm to choose reasonable peer firms? We don't want too difficult target. We don't want too easy target. Can you help hedge funds to raise their voice, to say something about the compensation contract, to make the contracting correct? All these you can do after 2006. After 2006, the compensation contract is out there. You can analyze the details of the compensation contract, and you can answer all these questions by analyzing the compensation data. So basically, that's the message. That's the message I want you to send out. You guys need to understand the structure of the compensation. You guys need to understand the different contingency. You guys need to know some examples, and you guys know what's the absolute, what's the advantage of absolute, what's the advantage of relative, and you guys need to know the data answer what questions. The data can answer questions by help board of directors to design an efficient contract. The data can help hedge funds to raise their voice, to voice out, to help the firm to design a better compensation contract. The data can help you to make managers to work harder. So the data can help a lot of people in a lot of ways. Eventually, what do we want? We want a better firm performance. We do all this for what? We do all this. Why we want to analyze this for board of directors? Because we want board directors to make managers to work harder. Why I want to do this for help hedge fund managers? Because hedge fund managers can monitor the firm's compensation. We do all this just to help want to help the firm to deliver better performance, to help the managers to work harder to deliver better performance. So that's pretty much what I want to talk about. We want to know the structure of the compensation. And more importantly, we want to know, using the compensation data, who we can help, what kind of decisions we can help with, who we can help, and that's pretty much that's pretty much